Have the markets finally stabilized, or is there more volatility ahead? Joining us right now, PNC Wealth Management Chief Investment Strategist Bill Stone and Federated Investors Executive Vice President Stephen Auth. Gentlemen, good to see you both. Thank you so much for joining us.
Thanks. Thank you, Maria.
Assess markets for us, Bill. Where are we? What would you be doing?
Well, I think we've seen obviously some come off the bottom. A little pullback today, if we get it, not unexpected given the real strong move we've had. I think Tony talked about earlier, I think we get some stabilization in oil, and I think the markets can continue to go up because I think the U.S. economy is showing some signs of strength, maybe an overstatement, but certainly better than the rest of the world. The things that I thought about after seeing the start of this week was that we may be going back to that whole divergence theme again, where you're seeing a slowdown in Europe, certainly that side. Japan, unfortunately, seems to be descending back into another slowdown, but the U.S. Is picking up pace again here in the first quarter.
So you would put new money to work in U.S. stocks? We
do like U.S., although I said I was on last time and I said I liked Japan. I still like Japan because it's not really about their economy as much as it's about their companies. Their companies continue to do the right things in terms of returning cash to shareholders, those kind of things that, for shareholders are the important part.
So earnings are not so bad in Japan?
Earnings are good.
Stephen, are you on the other side of that trade in terms of putting new money to work?
Yeah, near term, we're playing defense here, Maria. We think this market volatility is continue. We think the U.S. economy, global economy is softening. Earnings are going in the wrong direction. It's not just the energy patch, financials, other sectors of the economy. So we think it's time to be a little bit cautious here. Longer term, yeah, this will be a great opportunity over the next few months to add to equities, but we wouldn't do it here. We think we're going to have some more volatility.
You know that old line, investors don't like volatility or uncertainty, or markets don't like uncertainty. Historically, that is exactly when guys like you get what you do benefit, because you get opportunities. Out of chaos comes opportunities. So down, say, 12% from the peak, how much more downside do you see? And would you be better served to buy into that if you're not expecting a recession?
We're actually thinking you could see another 10, 15% downside.
Wow.
We actually think, yeah, we're in a kind of difficult patch for the market here. So we think you play a little cautious here, play defense, and then you'll get a better buying opportunity at lower levels.
When you say play defense, what does that mean? Raise cash?
Raise cash, buy defensive stocks, stocks with good dividend payments, big diversified businesses, consumer staples areas. That's where we're kind of hiding at the moment.
What are your investors doing? Have you seen nervousness in terms of the money flows, in terms of the asset flows? I mean, does that add to your concern?
Well, we've had, at Federated, we've had some pretty good performance, so actually we're seeing positive flows even this year, although we're tilting it certainly towards our more conservative strategies. Our dividend strategies, our hedge strategies are really the ones that are garnering most of the flows right now.
Stephen, what would make you change your view? What would make you change from the 10 to 15% correction to saying, okay, we're in, let's go?
That was the subject of a macro meeting we had yesterday afternoon.
And you lowered year-end targets.
We lowered our numbers. I mean, we have a lot of quantitative models to make sure we don't get too emotional. So I want to see our recession model start to tick down. It's been ticking up for the last several months. So we think there's an opportunity. We're not seeing a massive recession here. We think the banking system's in good shape, the consumer's in good shape, but we could see a technical recession, or at least a significant soft patch. I'd like to see that model start to switch.
This year or next year?
We think sometime later this year.
And you feel like you're looking at earnings, and they're not as bad as you thought?
Right. I mean, especially when you have to carve out the energy and really the commodities area, but outside of that, they continue to come in well. If you look at profit margins, excluding energy, they continue to move higher. So the fact is, companies are continuing to earn good money, and to me, stocks reflect earnings over the long run.
But they were down in the fourth quarter.
Right,
they were down
with energy. With energy.
Well,
But you're stripping out energy.
Ex-energy, you're up 2.5%. And my whole thesis is that the market follows the direction of earnings, but net-net, it's negative.
And you look at guidance, core guidance was brought down at the end of the quarter. If you look at what the Fed is going to do, there's no way the Fed hikes in this scenario. And that's another thing that puts a cap on the market. If things do stabilize, she hikes, that's going to put more pressure on emerging. So you take 2 or 3 Fed hikes out of the financial sector, which we had those hikes in our earnings estimates going into the year, you've got an earnings problem in the financial sector, which is a big hunk of the market.
And That's what actually happened in 2011 as well. And you actually bottomed the long end of the interest rates in 2012. So it got worse for banks, yet their stock performance was huge off of that 2011 low. So,
right.
Stephen, that's all I'm worried about, is that you're right on the defensive side. However, it's already been played out with a correction unless you go into a major recession.
In 2011, Maria can tell you, I was here. I was very aggressively optimistic at that stage. And the reason was, there's a chess game going on here. Policymakers had a lot of option in 2011. You could make that call, and you knew that they were going to re-stimulate. Here, we don't have a lot of weapons on the policy side. I'm not worried about that in terms of causing the economy to collapse, because we don't really need them. But we do have to have the markets and the economy clear on their own this time around. We can't rely on big central bank action. They're out of bullets. Look what's going on in Japan. They cut rates negative. The yen is strengthening.
Yeah. Well, they went to negative rates. I mean, that seemed, was that a little desperate?
It's starting to look to the markets like, wow, that didn't work so well.
What about you? Because you like Japan and negative rates.
Yeah, I mean, I think, again, it's a separation between their economy and their companies. I know they're trying to break, they're doing anything they can do to try and break that cycle of deflation, whether you agree with what they're doing or not. Yeah. But I'm kind of separating that to the side and saying, what I'm interested is, one of the arrows was trying to get companies in Japan to pay more attention to their shareholders, and that is actually working. So,
just really quickly, you see the market rallying in the last few days. That inflation number last week, everybody all of a sudden is like, oh, deflation's not a concern anymore. And I think that optimism will be fleeting, potentially, to Stephen's point.
I do want to stress, though, I think the banking system is in great shape here. We're not heading for an 08-09 kind of collapse.
I'm glad you mentioned that, because J.P. Morgan's having an analyst meeting today, and this whole question about credit quality, about auto loans, and that's a small part of the business, but that's going to be, the macro story is going to be probably one of the big stories at the J.P. Morgan analyst meeting today.
We just got to let the markets clear on their own here this time.
Stephen Auth, Bill Stone, good to see you, gentlemen.
Thank you.
Thanks so much.
Thank you.
We'll see you soon.